What is government securities, G-seconds? Government securities, G-seconds, are issued by the RBI on behalf of the government. G-seconds represent the borrowing of the government, mostly to meet the deficit. The deficit is the gap between the government's income and expenditure. G-seconds are issued through auctions that are announced by RBI from time to time. Banks, mutual funds, insurance companies, provident fund trusts, and such institutional investors are large and regular buyers of G-seconds with a view to encouraging retail participation. The government has reserved 5% of the auction amount in every auction for non-competitive buyers, including retail investors. In order to buy G-seconds, retail investors have to open a constituent SGL, CSGL, account with their bank or any other holder of SGL, Securities General Ledger, accounts. The CSGL account is held as part of the accounts of the offering bank, in which the G-seconds are held as electronic entries in demat form. Investors can also transfer the G-seconds to their normal demat account, after buying them. The price at which the retail investors are allotted G-seconds as non-competitive bidders will be the weighted average price of the successful bids in the auction. There is no cumulative option in a G-second. Interest is paid out on pre-specified dates into the designated bank account of the investor. Interest is not subject to TDS but is fully taxable. Redemption proceeds are also paid into the bank account. Though there is a retail debt market segment in which all issued G-seconds can be traded, there is limited liquidity for small lots of G-seconds. The institutional market where the trading lot is 5 crore is quite active. Retail investors may have to hold the G-seconds to maturity. G-seconds can be offered as collateral for taking a loan from a bank. G-seconds are benchmark securities in the bond market and tend to offer a lower interest rate compared to other borrowers for the same tenor. This is because there is no credit risk or risk of default in a get. The price of the bonds in the secondary market will respond to changes in interest rates. An increase in interest rates sees the price of existing bonds depreciate and vice versa. The extent of change in the price of bonds is a function of its features, and bonds with a higher tenor see a greater change in price for a change in interest rates. The low liquidity in the secondary retail markets may mean that investors may not be able to sell and realize the gains in price if any. Mutual funds are subject to underlying risk. Please read all documents carefully before investing.